What's going on? Ryan here. Super excited. In this video, we're talking about another amazing strategy, covered calls. I got Thinkorswim loaded up, and again, we're looking at Amazon here. The markets are closed, so I'm not able to actually execute a trade like this. But what we can do is look at a poor man's covered call, and we could use these futures because the futures are open. Okay, so what is a covered call? Well, a covered call is where we're looking to be long the underlying asset, right? So you either own the stock, you own the shares, or for instance, with the futures here, we could be long the futures contract. So I'll give an example. So if we come in here to this trade, what I'm going to do here is I will just buy outright one of these futures. Okay, so here's the active futures contract, right? Here's the last, here's the bid and the ask. So I'm going to buy, we'll just say, for example, we'll buy 2 of these. Okay, buying power effect, it's $25,300 of margin. So I put this order in, and I'm buying these futures. All right, let's see if we can actually get a fill. It says the market's at 46.2850. So 46.28. Right, so this is the annoying part of using simulated trading, right, is you're not always going to get a fill. There it goes, right? So okay, so as an example here, now we're long 2 of these futures contracts, and for this example, right, obviously we don't know what's going to happen here. The market could rally or whatever, but now that we're long the underlying asset, right, which is the futures, for the stocks it would be 100 shares. What we can do now, remember, the underlying asset and the options are interchangeable. Okay, so what does that mean, right? Well, that means that I'm now long the futures, right? Because I just bought those futures, which means I could come in here and I could sell calls against these options, right? So, for example, we're coming into Christmas, right? If I wanted to sell some calls against my futures position, right? Maybe I think, let's look at this on a different time scale, right? So here, this is a perfect example, right? So the market is volatile, right? It's making large moves, and now here's this one standard deviation range, so it's rallied back up. We don't know what's going to happen, but maybe we could think that it's going to continue this trend lower until it maybe trades sideways and then breaks out to new highs. But whatever it is, we're long the futures, and now we can sell calls against it, which is known as a covered call, right? A poor man's covered call, which a lot of people use, is where you could, instead of buying the shares or the futures, right, you could buy a deep in the money call with more time and then sell shorter term calls against it, right? So, but for this example, right, remember I just bought the 2 futures, and now I can come in here and let's look. So for 1 day left, maybe I think that this market's going to go down. So what I could do is I could sell these calls, right, at the money, and I'm going to sell 2 of them against the futures I own, and we'll see if we get a fill. So market's at 19. I'm not sure if I'm going to get filled here, but understand what's happening here, right? So how do we make money here, right? We're long the futures, right? So if the market goes down, we lose. If the market goes up, we win. Covered calls can be a very great way to make money on long-term investments that we own, right? So imagine if you had $1 million in Apple, right? If you had $1 million in Apple, you could then sell these calls against your Apple shares and you could start making income from the depreciating asset that we sold, right? We're selling these calls as time goes by. The option premium erodes away because of theta decay, and we keep that money, right? The risk for the covered call is always in the underlying asset if the market tanks, because remember, if we own the shares and we sell those calls against it, if the market rallies, we will have those calls that we sold become in the money, and then our shares will be called away, right? We'll have to sell those shares at the strikes that we sold those calls, and then we would be out of the trade, right? The other thing that can happen, right, is that you're long the underlying asset, right? In this case, the futures, or you could be long the stock, and you sell the calls, and now the market starts to trade sideways, and you keep all the premium from the calls you sold, and you still have your stock, and you can sell more calls, right? So covered calls is a great way to add additional income to a portfolio of assets that you already own, right? There's not too much risk when you're dealing with these covered calls, except for the scenario when the underlying just flat out tanks, right? So I don't think I'm going to get filled here. I'm not sure why, but what I could do is maybe I come into a different contract. And again, what I could do here is I could sell 2 of these, right? 29.50, 30.25, 29.50. And obviously, this is always the most irritating thing, right? Is when the market's not open, or you're trying to conceptually think about a strategy. When we're dealing with simulated trading, right? We're not always going to get the best data or the best fills, right? That's the limitation of the paper trading. But still, paper trading is an invaluable tool to use when you're first learning, when you're conceptually thinking, when you're looking at these strategies and messing around with things. Let's see if this will fill. It should. I don't know why it's not. That's okay. Either way, important to understand, for me, I really like to think about the underlying asset as exchangeable with options, right? And when you start to understand this, that the options and the underlying can be used together in certain ways, right? Either using options as insurance or using options as leverage to move in and out of positions, right? There's a lot of different things that you can do, and covered calls, I think, are a great way for passive investors to utilize options to help them add more income to their portfolios, right? Because at the end of the day, we don't want to day trade a lot, right? We want to have high income paying job, whatever that may be, if you're in the business of securities and you want to become licensed and manage money, right? You have to learn all these things and be able to pass the tests, and then go out and work with a broker, either become a broker, right? Work with brokers, whatever it is you want to do. But very important to understand and have goals for yourself. And at the end of the day, right, we want to just save as much money as we can into assets that can compound over time, right? And covered calls are a great way for passive investors to add income. Now, it's very important that if you're building a portfolio, right? I personally, when you're building your portfolio, you really want to think about what you're buying long term, and if you can trade options on it. Can you use options to enter and exit the position, right? Because there's a lot of ways to free up capital when we start to understand how interchangeable options and underlying assets can be. And I highly suggest that, you look at covered calls as a way to supplement your portfolio with additional income by simply selling these calls against stocks that you already own, or specifically choosing stocks that you think would perform well by using covered calls. Okay, so again, in this particular example, the covered call that I was looking at is, being long the futures and then selling calls against it. Okay. If we were looking at Amazon, right, the covered call would be where, we own Amazon in lots of 100 shares, right, which is very expensive. Remember, a $3,408 stock, right? So 34.08 and 34 cents times 100 shares. Now you're talking about $340,000 that you would need to own at a minimum to be able to execute this covered call where you're selling the calls against the stock. But again, the other scenario and the same way to look at this conceptually would be the poor man's covered call, right? Where, for example, we are buying a deep in the money call, right? Something that performs like 100 shares. So maybe this 3,300, right? We're buying this 3,300, and then again we could come in here to a lesser time, like less time, and this is kind of a hybrid position, right? Where it's kind of like a calendar spread, and it's also like a vertical spread where we're buying the longer term deep in the money call, and then we're selling that shorter term out of the money call that's basically covered by our long-term call that's in the money. Okay, so different ways to kind of achieve the same thing, but just know that if you own shares in 100 share lots, that using and selling calls against those shares can be a very lucrative way to bring in income. So again, if you have any questions, I love hearing from my clients and my students. Reach out to me. Let me know what you think. Let me know if you've used this or you've looked at it, or if you have any questions. And again, I look forward to seeing you in the next video.